Welcome to everybody. Thanks for joining us today. My name is Callie Knabley. I'm the project manager for ICBA Independent Banker Magazine, and I have the pleasure of introducing the speaker for today's webinar event presented by Reich and Tang. Tom Nelson is Reich and Tang's Chief Investment Officer and head of FDIC insured programs. He works extensively with community bankers to develop balance sheet management strategies and comprehensive funding programs that increase profitability, reduces costs, and enable banks to maintain precise balance sheet liquidity levels on any given day. Mr. Nelson previously served as the Director of Institutional Sales at IDC, where he was responsible for building its FDIC-insured deposit program and introducing it with the trust, bank, broker-dealer, and institutional markets. So take it away, Tom.
Well, thank you very much, and I want to thank everybody for their time today. I hope you find this useful. Just a couple of housekeeping issues on our side. If anybody's got any questions during the session, please feel free to use the question box on the screen. We will try to answer as many questions as we can during the session, and if we're not able to answer any question during the session, certainly we'll follow up and answer the question after the fact. Wanted to just give a quick update on what we're going to talk about today. We're basically going to try to talk about what has occurred from a regulatory perspective in the financial markets that has affected the use of money market funds and FDIC sweep programs, and how the regulatory change has really impacted what is potentially the logical decision for intermediaries such as trust departments, how they should use the two products and which ones will offer the most value. I wanted to start with just a quick rundown about Reich and Tang. Reich and Tang is a market leader in FDIC-insured bank sweep programs. We also provide money funds currently to our intermediaries, have been doing so since 1974. However, and this will become clear through the presentation, we have made a decision recently to exit the money fund business, which we are in the process of doing. Largely because we feel that FDIC sweep programs are a far better solution for clients, and it's a far better business decision for us to offer going forward. So currently, or in the near future, we'll focus solely on deposit and liquidity solutions. We help banks raise capital, and we also help, or raise funds, and we also help investors from a variety of different types of intermediaries place deposits. We work with bank trust departments, broker-dealers, registered investment advisors, and the like on placing deposits. And what we really do is help banks in a way to provide a precise balance sheet management so that they can, at any given time, have the exact number of deposits that they want on their balance sheet, by helping them take more deposits at a given time, take less deposits as necessary. For ICBA members, we provide, as I indicated, balance sheet and liquidity management tools. We also offer, in essence, an investment vehicle that is directly competitive with money funds that offers extremely high levels of FDIC insurance to all customers. Currently, our program offers $20 million worth of FDIC insurance to individual accounts. And we really are working with many trust departments to increase their efficiency and profitability, and also potentially allow them to work better with the bank side, the actual deposit side of the bank, not just in the trust space. So what we're going to talk about today is a solution to take advantage of regulatory change. We offer a multi-million-dollar, as I indicated, a $20 million FDIC-insured sweep program. That insurance is at the end client level, not at the trust department or intermediary level. It has a significant yield advantage currently to money fund. It eliminates all the market risk associated with money funds from a break-the-buck perspective, floating NAV perspective, and really a credit perspective, since all the deposits will be FDIC insured. It's outside the scope of money fund reform, so you don't have to deal with the issues about floating NAV, about whether or not your customers are retail or institutional, being that it is not a mutual fund, not an SEC vehicle. It is outside the scope of all of those issues. It provides revenue opportunities, both in terms of an enhanced yield to end clients, but also, as we'll go into a little bit later, the possibility for intermediaries to potentially take some revenue, have a revenue earning situation, if most likely if they're not acting as fiduciary for some clients. And the biggest issue is it now makes the deposits that are the sweep deposits that are within a trust department fully available to a bank as in the form of deposits, without having to violate any of the prudent man fiduciary responsibilities that a trust office or trust department would have. So regulatory change, what's happened? I think that the top slide or the top graphic here basically highlights what the biggest issues are from a regulatory change perspective. On the one hand, you have the SEC, who in money fund reform has indicated that maturities need to be shortened, and that risk needs to be significantly reduced within portfolios, and has done so over the course of the last 5 years. And then on the other side of the coin, you have Basel regulation, which has indicated that issuers, banks, large financial institutions, have to lengthen the maturities of their deposits to protect them against runs on the bank, runs on the financial institution, and ensure that we don't get back into a situation we were in 2009, where there has to be significant taxpayer bailouts of large financial institutions. So you have this push-pull issue where you have money funds that are being forced to buy shorter and shorter maturities, and at the same time, the biggest issuers, which have always been large financial institutions, both domestically and overseas, being forced to issue longer and longer maturities. Because of that, the large financial institutions in the world have turned away from money funds to a large extent. Increasingly, these institutions are looking for more Basel attractive deposits than what they can get in the traditional wholesale funding market, than what they can often provide to money funds. So one of the big issues is that Basel has traditionally assigned a 100% runoff rate to any short-term deposits that they issue to money funds, any deposits that are less than 30 days of maturity, and any longer deposits will become 100% runoff once they are under 30 days, whereas they've assigned a 25% runoff to deposits that are within sweep programs. And what you see is a situation where banks are willing to pay for large, reliable, long-term, stable funding sources. And as a general rule, these deposits have delivered that for all banks. So what we see is a situation where banks are increasingly looking to not issue traditional wholesale deposits and are instead looking to issue deposits into sweep programs where they get far more attractive Basel treatment. On top of that, you obviously have the issues associated with the most recent money fund reform. In July of last year, the SEC issued a series of new requirements, new rules as it pertains to money funds. And I think the highlight of what they did was two issues. One, they drew a bright, dark line between institutional and retail investors, and very clearly have said institutional bad, retail good. The only thing is that their definition of a retail investor is not necessarily what most intermediaries or investors in the market believe retail is. They have done it very, very clearly based on, I think in the simplest description I would say, in a tax ID versus a Social Security number basis. So retail investors now are really only natural persons, only individuals, only accounts where the beneficiary of that account is absolutely an individual. So what this means is that any type of small institution, which I think generally the market has believed would be a retail account, things like small foundations, small pension accounts, small business accounts, charities, municipalities, entities such as entities like that, they are absolutely now deemed to be institutions and not retail. On top of that, what the SEC has also done is they basically said government funds and prime and municipal funds on the other side have to be treated very differently. Using the same analogies they used before, government funds are good, prime and institutional funds are not. Prime and municipal funds are subject to a floating net asset value in their portfolio if they are not solely retail funds. So what you have is a situation now where a large number of investors are assessing what type of funds make the most sense for them and whether or not they want to be in retail, whether or not they qualify as a retail investor, and if not, whether or not they want to be in government funds and prime funds and what the implications are of them. Additionally, within all prime and municipal money funds, the board of directors of those funds have the ability to impose gates and or fees in times of stress. So what that basically means is when the liquidity available within those funds falls below prescribed levels, the boards of those funds have to look at the situation and decide whether or not to impose any fees or gates. In some situation, the SEC requires them to impose those fees and gates, absent them finding making a determination that a situation does not require them. So they put the onus on them to say that it doesn't need to be done, as opposed to putting the onus on them to indicate when it does need to be done. Kind of important from a fiduciary responsibility that they would have to make an absolute determination that those gates do not need to be put in at a specific time. The implications of these changes are fairly significant for intermediaries. There's an added level of compliance. So what's going to end up happening now is that intermediaries are going to need to determine whether or not their investors are in fact institutional and retail, make some kind of attestation to the fund company that the accounts that they're delivering to them in their retail omnibus accounts are in fact accounts that are subject to retail treatment under the SEC guidelines. The onus is going to be on the intermediary to make that determination and to make that attestation to the fund companies that these are good investors, depending upon whether they're in retail or institutional funds. Again, smaller or mid-sized foundations, corporate accounts, municipalities, they're going to be treated the same as Apple, General Electric, Honeywell, et cetera, et cetera. These are institutions in the SEC's eyes, whether or not they're $1 million, $2 million in size, regardless of size, they're institutions. And the other implication that we've seen is that we're starting to see fund companies move away from prime funds and towards government funds to ease this issue. For instance, Fidelity announced that the largest fund that they have is going to be moving from a prime fund to a government fund. All of this is related to the issues around whether or not the investors in those funds are appropriate to be in a prime fund versus a government fund. What we're seeing is all of these regulations are leading to a series of investor shifts. we're seeing not only money moving. Sorry, I think I'm on the. Okay. I'm sorry. I apologize for lost train of thought there. We're seeing a significant amount of money move from prime funds to government funds, and more importantly, what we're really starting to see is a significant amount of money moving from money funds in general into FDIC-insured sweep products, which leads us to the question of kind of why now. And what we're starting to see is that as all of the regulations are feeding through the market, we're starting to see a significant change in the yields available on FDIC sweep programs versus the yield available on FDIC-insured programs. So if we go back a couple of years, our FDIC sweep programs, for instance, we're lucky to yield what a prime fund did. In most cases, yielded a little bit less than what a prime fund did. Now, as we fast forward 2 years, as regulation, especially Basel, has started to really come into play, yields on FDIC programs have grown significantly, and we're at a point now where gross yields on these programs are significantly higher than prime funds, and every month yields available on these versus prime funds is starting to widen, and we're seeing the spread between FDIC-insured sweep programs and government funds, start to grow dramatically. Addition to that, the fact that you now have money fund reform that is somewhat cemented, isn't in place yet, but will be fully in place in June or in October of next year, starting to be in place earlier next year. You're going to start to see, I think, an increased movement by investors from certain types of money funds into other types of money funds or out of money funds altogether, either into FDIC-insured sweep programs or into some type of separately managed account, direct investments, things of that nature. But most of that money movement will not occur until next year as investors get to the point where they, see the whites of the eye, so to speak, of regulation really impacting them. Right now, it's still a year out. Decisions don't have to be made yet. It's next year's decision. But we're starting to see those questions asked. We're starting to see a small amount of money move. We expect that to really ramp up towards the end of this year and into early next year. FDIC insurance has always been something that's been extremely attractive for investors. It has always been, the gold standard. That's obviously something that continues to be the case. One of the other reasons that we're starting to see people consider FDIC-insured sweep programs, and we're starting to see large intermediaries move more aggressively, is it just removes all of the risks associated with money funds and all the risks associated with money fund reform. So we don't have to, intermediaries that are moving towards these programs do not have to deal with money fund reform, and they do not have to deal with potential issues around breaking the buck. And then finally, from a technology perspective, technology continues to improve on a, monthly, annual basis. These programs, sweep programs, require a significant amount of data to be held. Balances have to be assigned at the account level. We literally maintain on a daily basis many, many millions of data points about who holds what. That has become significantly easier over time as technology is ramped up. So what exactly is an FDIC-insured sweep program? For those of you who may not be familiar with what exactly a program is, from an investor perspective, it works basically the same way a money fund sweep works. I look at it as a money fund where my investment options are FDIC-insured deposits as opposed to governments or repo or commercial paper or bankers' acceptances or whatnot. So everything that gets put into these programs is an FDIC-insured deposit as opposed to the items that are going into a money fund. What happens is in the case of ours, you have the program administrator allocates cash balances to FDIC-insured institutions, and they do so that no client's cash balance ever exceeds $250,000. So we take at the client level, we allocate balances for specific clients to specific banks so that no tax ID or Social Security number is ever holding more than $250,000 at a specific bank at on a given date. And all these programs offer very high levels of FDIC insurance. We currently offer $20 million worth of insurance to individual accounts, $40 million to joint accounts, and so forth and so on. So graphically, if you look at how a program works, you start with the investors on the left-hand side. Those investors would be your clients. They come to a trust department. When we talk about trust department, we're talking really about all types of investment management accounts within banks. This also is the case for registered investment advisors, trust departments, bank trust departments, and broker-dealers. So those investors have accounts that are managed by one of those entities, in this case a trust department. Those accounts all have sweep balances available. They're aggregated at the trust department level, sent to the intermediary. In this case, the name of our program is the Demand Deposit Marketplace. Rich and Tang acts as the owner of that program. We then send out money to each bank that takes balances on behalf of the program and keep books and records to make sure that no individual depositor, individual investor ever has more than $250,000 at a specific bank. Now, one of the nice things about these programs is that you as an investor, so to speak, at the bank can put your client's money into the program. We can also send money back to your bank from other customers of other intermediaries so that your bank can now control and basically gain access to your customers' deposits without having to deal with any of the fiduciary issues associated with you putting money onto the balance sheet of your bank. So you can put money into the program. That money goes out to all third-party banks. Then we take money from other banks, other customers, and send it back to your parent bank. It's a way for your bank to basically gain access to these customers without a statement saying that you put money into those banks. So what is the value of these programs to investors? Well, safety. Currently, as I indicated, $20 million of FDIC insurance per tax ID, $40 million for joint accounts. Deposits are insured by the FDIC, which in our opinion all but eliminates all credit risk. There's never been an instance of a FDIC-insured deposit not getting paid back in full. That can't be said for money funds. There have been a couple of break-the-buck situations. Obviously, the Reserve a couple of years ago is the most notable of that, but there was also an instance back in the early 90s as well. The demand deposit marketplace would also allow investors to avoid any of the issues associated with fees and gates of money market that is coming with money market reform. So liquidity is never going to be an issue. Every dollar in this program is placed into a MMDA or a DDA account. There is not any CDs in the portfolio. No money is locked up. So if every dollar of every investor from every intermediary we did business with decided to pull money out today, we have 100% call on every single dollar in our program every single day. It's got a competitive yield. Currently, it yields significantly more than Treasury and government money market funds. It yields more than prime money market funds. Currently, the yield on the program is 18 basis points. Compare that with almost all money funds that are currently paying either 0 or 1 basis point, and the average of all money funds currently at 3 basis points, which includes obviously some super institutional prime funds, but still there's a massive yield differential between what is available in these programs and what is available in money market funds. So one of the questions that often is asked is how are you able to deliver these kinds of yields compared to money market funds? Well, there are currently about 7,000 banks in the country. All but a handful of those banks are not too big to fail banks. There are only a handful of very large too big to fail banks. The vast majority of banks are community banks. They're small, medium-sized banks who do not really have access to the capital markets the way that large financial institutions do. So for them, being able to access deposits out of a program like this with one contract, one agreement, access thousands of different customers at a given time is very, very attractive. Based on that, banks are willing to pay relatively attractive rates compared to what money fund investors can get when they manage, or money fund advisors can get. So that is the biggest reason that we can offer attractive yields, is that we're able to bring thousands, if not tens of thousands or hundreds of thousands of clients to a bank through one contract in one way, and they're willing to pay up for that. It's a very efficient way for a bank to raise deposits. How many places can a billion-dollar bank, for instance, go out and get $50 million in deposits in one fell swoop? There aren't very many situations where they can do that. They can easily do that with us. So we exploit those efficiencies, pass those higher yields on to end clients, and this really becomes a win-win situation for both the issuer of the deposits as well as the investor in the deposits. I'm sorry. So, then the question becomes, what's the value? Obviously, the bank, bank trust department, investment managers. This is a very attractive sweep option. We believe that it's a better credit quality program than most money funds. You have the FDIC insurance. Currently yields more than just about any money fund. In fact, all money funds at 18 basis points. And it's very easy for investors to understand. Investors understand what FDIC insurance means, how FDIC insurance works, and there is a tremendous comfort associated with FDIC insurance. We're getting increasing number of questions from our intermediaries that they're getting from their retail investors. What does money fund reform mean? Why do I not have to worry about it? What do I have to worry about? And what we're finding increasingly is that intermediaries are tired of dealing with those issues and find a money fund, a FDIC sweep, to be a far more attractive issue in that it quells all of those types of questions. We believe that FDIC-insured programs provide investors with the best mix of yield and safety available in the market today. And I think more important, our view is that regulation has not yet fully fed through the market. And we expect that over time, the discrepancy in yield between money funds and FDIC-insured sweep programs will only grow. We have not yet gotten to the point where all of this regulation has fully impacted both issuers, nor has it fully impacted investors, and we expect the spread on these products to continue. The yield, for instance, on our program over the last year, it was yielding about 8 basis points a year ago. It's yielding 18 basis points now. that is directly a result of more and more banks realizing that these types of deposits are more attractive for them to take than many other types of deposits. So we expect that yield differential to continue. We believe that banks and all fiduciaries have a responsibility to their investors to provide them with the best investment options available. This clearly, I think, satisfies that at all times. It's also really an ideal solution for investors that struggle to use traditional prime money market funds, entities such as municipalities, litigation accounts, that are often a big investor type within investment managers and trust departments. FDIC sweep programs do not have any prejudice about any kind of accounts. We take all types of accounts, individuals, institutions, IRA, litigation accounts, municipalities, if any type of account we take. I got a question here about do we dictate to the banks, to the intermediaries, the yield that they should be paying on a daily basis? No, we don't. One of the beauties of this program is that it is outside of the SEC world, so you have complete flexibility on what yields or on what rate you pay to your end clients. You have the ability to tier rates so that you can pay larger customers higher amounts if you so desire. You have the flexibility within the program to pay your end client any rate you want. And I think that becomes especially important when you have non-fiduciary situations. So if you act solely as a custodian, you have the ability to pay a much lower rate and keep a significant amount of income for yourself in terms of fee revenue. And then, last point here, as I indicated, DDM can be used for all types of investment advisory, custody, and trust accounts, and you have the flexibility on how you're going to use the program for different types of customers. What's the value to the bank? Well, the big issue to the bank is that it now has the ability to access trust department cash assets. I personally grew up in a trust department. My first job for a number of years was working in a trust department at a large bank. And we always used to get the question from somebody on the bank side of, why can't I have the deposits of your customers? And the answer always seemed to be from the trust side, our customers are paying us a fee to manage money. It doesn't look right. It doesn't smell right. It doesn't feel right to be putting money that a customer is paying me onto the bank's balance sheet. Well, different banks have different takes on that, but where that is an issue, this clearly allows banks to access those deposits without any of those fiduciary responsibilities. So we or breaking any of those fiduciary responsibilities. So we send back deposits from other institutions to the bank, and the bank has the ability to dictate how much of the trust deposit assets that it sends into the program it wants to take back. So if a trust department sends in $35 million, the bank can choose to take back nothing, $5 million, $10 million, $15 million, $35 million, or it can choose to take more money back in a situation where it needs deposits. But we will always guarantee a bank that anything you send in, we will send back to you in the form of deposits from other customers. So it kind of takes that loggerhead issue that bank trust departments and bank treasurers have to deal with. It takes that away and gives trust departments a way to help the bank source deposits without having to have a statement that says that they have sent and put money onto their own bank's balance sheet. It also is obviously a very reliable source of funding for banks on a long-term basis because they know the customers, they know what the customers do, and they typically control to a large extent how many customers are in the program. It's also an ideal contingency funding plan for the bank because it has access to these deposits when it needs it, even if it isn't taking it at a given time. How does DDM work from an operational perspective? It works very simply, is the only way I can describe it. It works just like a money fund. Daily availability of money, daily ability to put money into the program. It works from an operational perspective. On a money wire perspective, it works on an omnibus format. So if you have 100, 1,000, 5,000, whatever it is, number of customers that use the program, you will still only send us a single wire. We will only send you a single wire back in events where you're taking money out of the program. So on a daily basis, there's only one wire back or forth. There's a choice of either a fully integrated solution, which offers $20 million of insurance, and we have integration with a number of trust accounting systems so that we can, this would work seamlessly for you. Or we can do this on an omnibus basis so that you just send us one amount. We make sure that we provide a lower level of FDIC insurance, but that FDIC insurance, and usually that would be at $2.5 million, would pass through to your end customers, but you would then be responsible for ensuring that no tax ID, no individual sent more than $2.5 million into the program. That onus would then be put on you in the case of an omnibus relationship because we wouldn't know who the end clients are. The banks that we place the deposits with, there are two things. One, those banks are available on an ongoing basis about what banks are available in the program. So we have a master list of all the banks that are taking deposits from us on a daily basis. That list is available to you at all times. We also will provide back to you where your customer's money is on a daily basis. So you not only see where the money is on a daily basis, you also see where the money could be tomorrow. You have the ability then to tell us that you don't want money placed in specific banks if for whatever reason you might not want money placed in a competitor bank, you might not want banks placed within your state, whatever it might be, you have the ability to control what banks do or do not take the funds from your customers going forward. So, in conclusion, what we basically think is that reform has created an environment where you actually can move from a product in the case of a prime money market fund to a higher credit quality product in the case of an FDIC insured sweep program. You can increase yield, and it really is an oxymoron that you can actually increase yield and reduce risk, but we believe that that is absolutely the case right now. We believe that that's going to, the yields available to customers is only going to continue to grow. The spreads between these products and money funds, that yield differential is only going to continue to grow. We give banks the ability to tap into trust departments' balances for their own bank balance sheet needs. And at the end of the day, we're providing what we believe is a long-term solution that banks, small banks around the country will be able to basically fund the needs of all of their customers through enhanced FDIC insurance and not have to push money off balance sheet to the too-big-to-fail banks. And finally, I think most intermediaries do not necessarily realize the impact of money fund reform and the requirements that money fund reform puts on intermediaries to make attestations to the money fund advisors, money fund programs, as to whether or not the customers, every one of the customers involved in their programs is either an institution or retail. So with that, if anybody has any questions, please feel free, to send them along at this time. The first question I've gotten is, how is the DDM program or FDIC investments in general expected to perform when short-term interest rates go up, if and when they ever do go up? I think clearly our expectation is that as rates rise, these programs will actually perform equal to, and I really would expect them to perform better. And the reason for that is very simple. One of the basic issues with banks is that as rates go up, they do not pay retail customers a commensurate increase in yield. They look to widen their spread with the expectation that some subset of those customers will leave the bank and go somewhere else. That small subset of customers leaves a deposit vacuum void that a bank has to fill. They fill that in the wholesale market through programs like this, and basically they're more willing to pay up for a very small amount of deposits than pay up for their entire program. So we expect that as rates rise, pressure we put on banks to look for some non-core retail customer deposits. They come to our programs and will actually help push yields on these programs up relative to Fed funds going forward. So clearly we expect that as rates rise, these programs will continue to perform very attractively. Another question I got was, do you think that these changes will require any amendments to our trust policy? I guess I would answer that question in two ways. When you say trust policy, if you're talking about the overarching policies, that a trust committee might have about acceptable types of investments, my guess is that there might have to be some slight tweaks to specifically indicate that these deposits are available. But I don't think necessarily, depending upon how guidelines or trust documents have been written at specific client levels, there would necessarily need to be any changes, because at the end of the day, all this program is an investment by you on behalf of your customers into an FDIC-insured deposit. I would expect that most customer guidelines, most trust documents would allow for that type of investment and wouldn't require a change. So, I think, on the overarching, trust committee kind of broad investment practices of a trust department, it really would come down to whether or not you allow for the investment into FDIC-insured deposits and how broad or not broad that policy is written. But I would think that it would be, if a change was required, it would be very minor, and I would assume that in most cases, because we're just investing in FDIC-insured deposits, no change would necessarily need to be made. I have another question here. My bank participates as a deposit-taking bank in your program. Well, thank you very much. Can a portion of my trust clients' deposits be directed to my bank? Yes, we can direct. Well, the question, I guess, then is that a question of whether or not specific clients can be directed to your bank, or whether or not a subset or a dollar amount can be directed to your bank? We can absolutely direct customer deposits from other customers to your bank in any increment that the bank desires. So we guarantee 100% reciprocity. So any amount you send in, we'll send at least 100% back. I don't think it would necessarily make any sense, any reason why we would want to send back your specific tax ID customer money back to your own bank, but we could probably do that if that was required. I think that answers at this point the questions that we've received. If anybody else has any other questions, I'll just give you a minute or so maybe to send any other questions over. If not, I'd just like to thank you on behalf of the company and ICBA, I would assume, for your time today. Hope this was beneficial. If you have any follow-up questions, I would please ask you, to contact us at any time. Thank you very much for your time today.
Well, thank you, Tom, and thanks to Rich and Tang for that great presentation. And thanks for everyone who's joined us today. Just to repeat a little bit what Tom said, in 2 business days, you will receive a follow-up email with a link to the recording of today's event for your review, or you can feel free to forward it along to any of the colleagues who were unable to attend today's event. And then for those of you interested in receiving a copy of today's slide deck, please send an email to info@rnt.com. That's info@R as in Roger, N as in Nancy, and T as in Timothy.com, and a representative will follow up with you shortly. This concludes today's webinar. I hope you all have a wonderful rest of your day.